The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Trepidation across global markets ahead of a big U.S. announcement on tariffs. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Bonnie Quinn, and we're kicking you off to the closing bell on this final trading day of the quarter, March 31st. And indeed, we have gone green. Can you believe it? We started off the day with a lot of fear in the market, that VIX almost at 25. We're now higher for many S&P 500 stocks. The Nasdaq, though, taking a little bit longer to go green. Of course, the Nasdaq also lower on the year, down almost 9% on the year before today. We have the 10-year yield at 4.24, so down another just a little tiny piece. And then spot gold has been trading at intraday records for most of the day, Romaine, which will tell you how much risk aversion is out there.
Yeah, it's kind of interesting. That last line on your screen really kind of reflects the sentiment in this market. A market still squarely focused on the economic outlook and Trump's so-called Trade Liberation Day. Now, we're still about 48 hours away from those announcements that will be about reciprocal tariffs on our trading partners. But the angst is already fueling that flight into safe haven assets today. Treasuries rallying, as Vonnie said, gold rising to a record, and the yen, a classic safe haven there, swelling to its strongest in about 10 days. And we should point out, being the last day of the month and of the quarter, it is a skittish end to the quarter, the first quarter of the year, a complete turnaround from how the market actually started 2025, with a 5% rally on the S&P over 7 weeks to a record high. Since that record high, sentiment has soured, and so too have stocks. The S&P course correcting, down more than 9% from that high. High-flying chip stocks plunging almost 30% from its highs, which were set back in July. The Mag 7 down more than 20% from its December highs, in Bitcoin, which surged above $100,000 in January, now down 21% since. All this leading Goldman strategist David Kostin, who cut his year-end target for the S&P to 6,200 on March 11. He cut it again today, just 3 weeks later, this time to 5,700. He joins Ed Yardeni, as well as Venu Krishna over at Barclays, among the strategists warning of weakening economic growth that could curb equity gains. And Mike Wilson at Morgan Stanley warns that for any investor seeking an end to the chaos and a start to clarity on that Liberation Day, April 2nd won't necessarily be the clearing event you would hope for. Take a listen.
I would say, defensively positioned, high quality. That's been our core portfolio. Now, we've made some trading calls lately that would have gone against that. Some of those worked, some of those didn't work. But I think at this point, you want to be up the quality curve. You want to be in businesses that can kind of mitigate some of these concerns. You have pricing power. You have the ability to kind of move production around. You can take inventory on to kind of buffer this for 60 or 90 days, which we've seen all of those mitigation strategies, something we wrote about in our note today. So those are the kind of companies we want to own in this period of time. I do believe there will be a clearing event at some point this year, but we're not there yet.
And that was Mike Wilson over at Morgan Stanley on Bloomberg Television this morning in Bloomberg Surveillance. As we march closer to the closing bells, let's bring in Stephanie Aliaga, global market strategist over at JPMorgan Asset Management. All right, Stephanie, so how do you, if at all, start to factor in whatever April 2nd and Liberation Day will actually bring?
I think right now is a time for caution. We are looking at the likelihood of a prolonged multi-front trade war that might only be closer to the beginning than the end on April 2nd. Mm-hmm. And I think it is a really important time for investors to consider whether they have a portfolio that is positioned to perform in various different climates. It's like walking outside in the spring of this season right now. You don't know if you're looking at a 70-degree day, a 40-degree day, rain or snow, But I think,
and we got 3 of those.
We got a lot of those this weekend. So. Exactly.
But what is that? What is that sort of all-weather, if you will, to borrow a phrase from Dahlia, that all-weather portfolio look like? Because in the past, it was big tech and the big cap names, and you knew that they would power through. But we've seen them really take it on the chin, primarily because of valuation. Where do you go right now?
So I think what's really hurting tech right now is just the fact that for investors looking to de-risk portfolios, like that's the source of risk in their portfolios, is given how much of equity outperformance we've had in those names. We've seen this rotation towards other areas of the market, similar to what Mike said, that are better positioned, perhaps in the midst of this trade war: energy, materials, utilities, financials, perhaps. And I think those make sense. But now you also want to think about how you're diversifying outside of just your equity allocation. So fixed income increasingly makes sense We're more bullish on increasing duration exposure, but also adding a little bit more of the rest of the roles in your portfolio, particularly given the fact that valuations there are just coming off of their cheapest levels in 25 years. So you just have a bit more favorable risk reward there.
Although we have run a little bit in some places like China, for example. How do you know if this isn't all temporary, though? I mean, Romain was talking about Ed Yardeni earlier, upping now his stagflation scenario probability to 65% from 55%, and the recession scenario to 35%. I mean, isn't it all probabilities? You can't sort of forecast anything except via probability.
The near term is very uncertain, to your point. And I think where markets are having a lot of difficulty is figuring out how do you price in a tariff reality. And there is going to be hits likely to various companies across sectors in the U.S. markets. There's also likely going to be hits internationally, which maybe aren't being appreciated right now. I think really it's fundamentals versus pricing. And that's what's really helping international right now. The fact that positioning there was historically low, and so we've seen that move so far. And now the question going forward is really going to be, how bad is the trade news? How how long-lasting the impacts are, and then ultimately, on a company by company, on a micro level, who is best, positioned to weather it.
There have been several themes in the market. The primary one, obviously, the AI theme, right? Yeah. How much does the theme itself go away off the back of tariffs? I mean, in a sense, Nvidia trading at 105 is now, cheaply valued compared to last week or the week before. But is it really, if the macro backdrop is also very much changing?
So I think one thing that we're seeing there is really the positioning. We're seeing investors shift away from the Mag 7 to help de-risk and move portfolios and build greater balance. There's also a lot of uncertainty in the AI theme itself. I mean, we've just been seeing over the last few weeks, if we didn't have all these tariffs to talk about, we'd be talking about the model upgrades that we've been getting, and just how quickly the AI theme is advancing makes it very difficult for analysts to make expectations around how many chips you're going to need. What is the kind of investment that you're going to need? What are the services that you're going to demand from AI? And so we're in this period of digestion, and I think NVIDIA is in the middle of that. For us, we have to take a medium to long-term perspective on this, and we remain quite convinced that there is a lot of value and a lot of need for AI investment here, and there's really only a few players there that are well-positioned to capitalize on that. But we're also seeing a pretty rapid diffusion of some of that value too, as the focus shifts to the application layer.
And I'm curious, I mean, as we start, hopefully, to see more companies come to market. We had CoreWeave last week, and I know that wasn't exactly a rousing success, but that seemed more idiosyncratic. As you start to see some of these AI companies and AI-adjacent companies, in theory, come to market, do you think they're going to be embraced by investors? Is there still appetite for that type of trade?
I think right now it's very difficult, just given how jittery markets are right now for all sorts of reasons. You have the uncertainty, particularly on the trade front, on the policy front. You don't know what kind of growth outlook that you're looking at. So that makes it very difficult to kind of see the rebound in IPO activity and M&A activity that we were expecting to see this year. Now, maybe if we get to the back half of this year and we see some of these worries settle down, we see those recession probabilities stabilize or even move lower, and we eventually get those pro-growth policies from the administration, maybe you can see some of that come to market. And there is a lot of kind of pent-up anticipation for that resurgence. But I also wouldn't necessarily be holding my breath.
I am curious as to how much dry powder is really out there. I mean, we've talked a lot about money market funds, still at a record, surprisingly, for some reason. But when you're sort of talking with your team, and more importantly, talking about what your clients and where their head is at, are they sitting on a lot of cash right now, or are they actually really invested in this market?
So there is, I think, some cash that's been on the sidelines, particularly benefiting from higher coupons that you're getting in cash or various sleeves of the fixed income market. I think for some investors that have felt that they had missed out on some of this rally in tech, they're finding it might be a good opportunity to get back in and get exposure to these long-term secular growth names. But most investors, I think predominantly, have just been owning the market and have been quite invested in that case. And so now looking at allocations, they're already looking at pretty sizable overweights to the leading tech names that have dominated. And now we just want to think about making sure we safeguard some of that investment performance that have.
All right, Stephanie, I have to leave it there. One of the best in the business, Stephanie Aliaga, global market strategist at JPMorgan Asset Management, kicking us off to the close here on this Monday afternoon. A focus here on the industries potentially affected by Washington policies, and that includes Norwegian Cruise Lines. Jefferies actually feeling bullish on the stock, initiating coverage today. We're going to explain why in just a little bit later.
And speaking of economic uncertainty, we'll discuss how all of this is affecting CEO sentiment with Richard Edelman, Chief Executive Officer at Edelman.
And a continuation of that conversation about the auto industry. No industry in the crosshairs more than that. We're going to talk to the head of one of the biggest Ford dealers in the country. All that and more coming up in a bit. This is The Close on Bloomberg.
Shares of Coinbase set for their worst quarterly slide since the collapse of FTX, as growing concerns about the U.S. economy weigh on digital assets. Nearly every other major crypto-linked stock has plunged alongside Coinbase. With us now with context on what's next for crypto is Mike McGlone, Senior Commodity Strategist with Bloomberg Intelligence. Hi, Mike. So, obviously, if we take Bitcoin, we have seen a decline, right? But we're still well up year over year. So why have the associated stocks taken such a hit?
Well, one thing remember about Bitcoin, it was born in 2009 and there was one. Now Bitcoin has millions of dependents, and you pointed that out. The Bloomberg Galaxy Crypto Index has started turning lower. The 200-day moving average is heading lower. It's peaked at a lower high last year, and it's heading downward. I think that's the problem. We have massive excess of supply, speculation, hubris, and it's just a normal bull market that's going downward. Now, the key thing is Bitcoin's outperforming, but it's doing unfortunately, what people thought it might not do. They thought it was going to outperform the stock market. We've had a 10% correction in the S&P 500, and Bitcoin's had about a 30% correction. That's not good if you're buying it to get diversification away from the stock market. But what's been going up is gold, and that to me might be a more enduring trend.
Well, I am curious, though, on the crypto story, Mike. I mean, a big part of the reason why we saw that rally, we saw crypto above the 100,000 mark on Bitcoin, was because of the potential for administration policies that would be friendlier. Now, there's no indication that the policies now are unfriendlier than what we had in the previous administration, but there hasn't really been anything new other than that executive order that Trump signed to study a crypto reserve.
So what I think has happened, Romaine, is they've unleashed the sorcerer's apprentice. And we've created so many excess supply of cryptos. Now there's like 12 million of them listed on CoinMarketCap.com. But what's happening is, yes, the technology is wonderful. They're pointing out how the tokenization is awesome, tokenization of all assets. And the number one traded crypto is the dollar. As we tokenize more and get access to the dollar on a global basis, where you can trade it on your phone for nothing, why do you need highly speculative tokens like XRP that's supposed to give you access to the dollar? So I think that's what's happening. What's happening also, we're pointing out, is we've reached such a high plateau of speculation and leverage that it's just going downward. And I just don't know where it stops, but I think that 100,000 level in Bitcoin rang the bell like the NASDAQ composite at 5,000 did almost 25 years ago. It's a question what stops. And I think the key thing people are learning in cryptos is they'll be okay as long as the stock market goes up. And people like Anna Wong and Gina Martin Adams say it's more likely to go down.
I'm still curious, though, Mike, about the custodians and the exchanges and so on, and why they're suffering so much, given that there is still plenty of volatility, right? Not just in Bitcoin, but in the other tokens and the stable coins and so on that you mentioned earlier, but particularly in Bitcoin. There's plenty of trading of it still, even more perhaps than a year ago, given that now we have at least one of the uncertainties out of the way, and that's that the administration is not going to sell confiscated Bitcoin.
Yes, well, the key thing is bull markets are great, and people who provide the shovels in bull markets for trading are always do much better than bear markets. So the market's turned over. Look at Ethereum. Ethereum's dropped from 4,000 highs. It's hitting 1,800 now. It looks like it's still heading lower. And that's the number two Bitcoin. It might be flipped pretty soon by Tether. Tether is the most widely traded crypto, but in terms of market cap, it's less. So what I think the market's showing you, and that's telling you, is we've flipped to a bear market. And there's always less trading in bear market versus enthusiasm of bull markets. And also a key thing to remember is Coinbase is just one, and commissions are just high. What's the administration opening up to do? There's going to be many more exchanges going public. Interest or commissions are going to go down, and that's a lesson I learned in the trading pitch of Chicago. We used to trade $12 a round turn in futures, and now it's maybe 12 cents.
Hey, Mike, one final question here, just to kind of put a bow on all this. I mean, you mentioned gold a little bit earlier, which is acting as that safe haven as it traditionally has. Are you actually surprised by that? Surprised that we saw such a move higher in gold over the last few weeks in the face of all the turmoil in Washington? but not necessarily that move higher in crypto, which was also supposed to be, as a lot of people would say, digital gold.
I wouldn't be surprised, Romaine, if cryptos and Bitcoin went up in this environment and gold went down. So to me, it's happening the way it should, as we have a little bit of normalization in risk assets, i.e. the stock market is just at, debt to market cap to GDP is the highest in 100 years, turning lower. And I think the key thing that's happening is that enthusiasm we saw last year is you're supposed to be selling when they're young, when they are, and now all that is turning towards gold ETFs. Gold ETF inflows are going straight up, and crypto ETF flows are heading downward.
Yeah, absolutely seeing that. Mike McGlone of Bloomberg Intelligence, spot gold right now, 3,100 and change, up 1% on the day. That is a record high. Bitcoin, the proxy here, 83,000 and change, higher on the day, but well below those all-time highs. When we come back, we're going to focus on some of the individual stocks moving on this day, and that includes Norwegian Cruise Lines, a new analyst and new coverage, and a buy rating. We're going to explain why, even in the face of tariffs. This analyst says this might be the stock to watch. That's coming up next here on The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with Alphabet. Mealy is actually cutting its price target down to 173 from 218, maintaining a hold rating. This is AI chatbots shake up traditional internet search business models. The analyst goes so far to say that Google could even become obsolete, and Alphabet could become this generation's Kodak. Shares, though, bucking the trend on the day, though we should point out, still on pace for their worst quarter since 2022. Next in line, Canada Goose. Barclays downgrading the Parker retailer to underweight, trimming the price target to $8 from 10. The analyst says the move is due to increasing competition and the potential impact from what else? Tariffs. Those shares down 5% on the day. And finally, let's take a look at Goodyear. This is the tire company, and it got an upgrade today to buy. This over at Deutsche Bank. The price target at 13, with Deutsche Bank saying Goodyear should actually be the relative winner amid the trade war, at least for now, since tires aren't included in those tariffs plans. Those shares rallying hard on the day, up about 6% as we await for that announcement from the president on Liberation Day, April 2nd. Those are some of our top calls. Another stock that we're keeping an eye on is Norwegian Cruise Lines. A new buy rating over at Jefferies, new coverage over at Jefferies, we should say, with the buy rating and a $25 price target. The analyst there noting that he's bullish on the overall cruise sector due to compelling demand. We're happy to have the analyst behind that call right now, David Katz, Managing Director and Equity Research Analyst over at Jefferies. All right, so David, give me a kind of the general consensus here as how demand holds up. I saw in your note, you talk a lot about this idea of a trade down by the consumer, but that's a trade down that would benefit the cruise lines. How so?
Yeah, let's just step back for a minute, because what we've learned over many years of covering travel and leisure is that people go on vacation, right? And it's a question of how and where and via what mode. And I think our argument is, perhaps a trade down in price, because a cruise vacation is on average 25% less expensive than an equivalent land-based vacation, right? And trading up in value, because I think the cruise lines are doing a number of things that I hope we'll get a chance to talk about to enhance that value proposition. What's also helping this, and it's an important part of the call, is that the supply of new cruise ships entering the market is, still recovering post-COVID, and it's on a long-term 5-year cycle, and is actually going down over the next several years. And so when you compare that supply and demand dynamic, that's why it sits favorably compared with the rest of our coverage.
When you look at economic conditions overall, or at least try to wrap your head around that, and I'm sure you talk to your economists there at Jefferies here, are you factoring in a material slowdown in consumer spending overall, not necessarily just for cruise lines, but I'm saying overall in the economy?
We are, and we contemplate that, and we talk about that in our report, which I hope people will find comprehensive. When you look at cruise lines, Royal and Carnival, who were publicly traded through many cycles, right, and many events, what you discover is that notwithstanding COVID, even through the great financial crisis, their occupancy levels were at 100% or better, and their EBITDA per passenger was actually positive through all of the different events and cycles that we've lived through. And so, again, on a comparative basis with the rest of our coverage, these are positioned quite well.
So, David, you said they're doing some novel things that you wanted to talk about. What are they, and how are they making those things cost effective?
Yeah, the game changer in the cruise business, not just for Norwegian, but for all of them, is private island ownership. And each of the companies is offering their own private islands that become a day as part of the itinerary, and customers are eating them up. I think Royal talked about their 2025 passenger flow. 40% of them are booking itineraries that include their private islands. And so, this is the new trend. I know other cruise lines that are private and outside our coverage are doing the same thing. And so it has changed the cruise value proposition. And what's great for the cruise lines is that they retain 100% of the economics from those private islands rather than dispatching customers in various places to spend their money elsewhere. And so it's a win-win for the cruise lines. And that's the biggest change in the industry.
Is there any concern at all about the Trump administration and what it might do in terms of policy? There was a threat back a while that, a ship needed to be based in the United States, or perhaps a ship needs to be built in the United States in the future.
Yeah, there is definitely debate and discussion about the tax code and the tax status of cruise lines. And that is a function of where they're based, where they trade, and that will be actively debated. And there's no escaping the fact that they pay very low tax rates, and whether that will change is anybody's guess. Look, we spend our days trying to figure out what's the worst case scenario, what's the best case scenario, and those brackets are wider than they've been for many years. And I think within that, the tax discussion is a part of it. But when we put it all in the pot, the positives far outweigh the negatives, and that's why we came out the way we did.
David, thank you so much. Pleasure speaking with you today. That is David Katz over at Jefferies. Well, we are going to be speaking next about CEO sentiment, Romain, and it's a very important thing. Ed Denny also mentioning sentiment not just among consumers in the English survey, but CEOs as well.
And it's interesting too, because these tariffs and other things are, or at least the announcements are coming kind of right before the start of the next earnings season, which kind of puts a lot of these CEOs in a bind because they're going to be asked a lot about this by the analyst community, by investors. The question is, what type of response are they going to have?
And in boardrooms, they've gamed out so many scenarios. If you were a CEO, that's what you'd need to be doing for your shareholders and your other stakeholders. Yeah. Well, we'll have that discussion on how impending tariffs are affecting CEOs and sentiment with Richard Edelman next. He's a CEO at Edelman. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to The Close. I'm Romain Bostic.
And I'm Vonnie Quinn. And of course, tomorrow is April 1st, Romain, but it may not be that full of jokes.
Yeah, we're here on March 31st. I mean, last day of the month, obviously, but more important, last day of the quarter. And it's amazing just how much sentiment in the market flipped, right? We talk about those record highs we were setting in January and into February on some of the major indices. And now most of those major indices are down 5, 6, 7% for the NASDAQ, and for the S&P. We're basically talking about correction territory here. This is something that I'm not sure is going to reverse anytime soon. Maybe April 2nd. Liberation Day becomes the clearing event. Maybe it doesn't. Well,
you have to ask why would that be any different to any other day? At least there should be discussions and negotiations after that, and maybe at some point we'll get. But the deterioration, as you say, has been rapid, and it's been pretty deadly for this market. There have been a couple of efforts to bounce. Last Monday we had this huge bounce. There was a Friday, and I remember there was a huge enthusiasm, and indices were up 2%, but they've been few and far between this quarter.
Yeah, absolutely. And we should point out to our viewers here, we're less than 2 weeks away from the start of the new earnings season. So a lot of the CEOs, CFOs, and other C-suite executives are really going to have to explain to their audience, whether it's the customers, whether it's the analyst community or their investors, exactly what their long-term plan is in the face of huge structural changes in our economy and maybe even the global economy itself. Tariffs are having an immense impact right now on CEO and business leader sentiment across the country. We've seen that in some of the survey data. And one person who knows more about that than anyone is Richard Edelman. He's the Chief Executive Officer over at Edelman. I'm pleased to say he's with us here in studio, too. Great to have you.
I'm glad to be here.
What is the mood right now, particularly amongst U.S. CEOs and U.S. executives who are sitting around watching what's happening in Washington, maybe not just fearful of what's happening, but at the speed of which it's happening?
I think CEOs still believe this is a pro-business administration. Mm-hmm. They are hoping that things settle down, that there is clarity to policy, and that, in fact, it will be smart to invest in plants and equipment, that it will be smart over time to make sure that America is a growth market. But they're also deeply interested in the trade relations between our big partners. Mm-hmm. And I was just back from a 2-week trip to Asia on Monday, and I saw a bunch of chief executives in Korea and Japan, and they all are investing in America, but also nervous about tariffs.
There's been a lot of talk about a certain level of paralysis when it comes to business spending, business planning, and maybe is a better way to put it here. Overseas, are you seeing that? I mean, I know some of these executives have either made overtures to invest in the United States if they didn't already have something here, or even increase that here. Are they willing to articulate that publicly yet, or is it still wait and see?
No, I think that they are definitely committed. You know, Hyundai announced the $20 billion plant in Georgia, opened it last week for EVs, and that's a massive commitment. And I think others are following suit from Japan, Korea, et cetera. But I do think the key question is, do CEOs stand up and speak up on behalf of their companies and their interests in this period? And I think they should, because silence is interpreted either as going along or not objecting to policy. And if you've got an interest in trade, you've got to absolutely make your case in Washington.
There does seem to be a little bit of a capitulation on that, though. We don't see too many US companies, at least, standing up and saying this is not good for our business, this is not good for our shareholders nor our stakeholders. Are you saying that we might start seeing some of that at some point?
I absolutely think that's so, because the interest of the United States-based companies is to have trade relations. And whether it's Canada, Mexico, Europe, or Asia, we've got to have an interconnected economy. And the global supply chains depend on it.
Well, to that point, how do CEOs and board members talk to each other and to the public and to their shareholders in this scenario before they get to the point where they're like, enough is enough? How do they protect their stock price, the value of their company?
I think that they have to talk first to their employees, explain, then they have to go to the board, but more specifically, I think they have to group themselves as automakers or food manufacturers so that they represent a constituency, not just selfish interests.
What about the message, I guess, to consumers or just the average, everyday American? This is a sensitive topic, but we've seen Tesla dealerships set on fire. Yep. We had the murder of a top healthcare executive a few weeks ago here. I mean, you guys do this sort of trust barometer, which kind of measures, how people feel about the government, how they feel about executive leadership. And I know in the past, I mean, certainly over the last couple of years, that trust barometer has actually shown an increasing level of trust in corporate America, at least relative to the government. Has that been eroded?
Here's what's changed.
Yeah.
We have a huge rise in this feeling of grievance, and nearly 2/3 of people across 28 countries feel aggrieved. And they feel discriminated against, and they also feel a lack of hope for the future. So what I think business CEOs should be talking about is well-paid jobs, reskill people so that they don't feel a sense of loss to AI, and also that they are part of their communities, that they want to talk to the workers, they want to listen. CEOs should be out and around. I give great kudos to the new CEO of Starbucks. He's getting out and around, Brian Niccol.
Are the CEOs prepared for this? I mean, the current crop. I mean, Niccol is, obviously one of the more premier CEOs, at least based on a popular opinion. But are the CEOs that you see in place now, do you think they're prepared for this environment?
I think that they are getting prepared. They have to meet the moment. And CEOs have got to earn the trust of their constituents, again, by action. And the action is really on reskilling for AI, making sure that prices of products are affordable, and again, that they deliver on good jobs, well paid.
It's questionable if we'll ever get past the tariff issue, right? We might be dealing with questions on uncertainty and changing tariffs for the next 3 to 4 years. I mean, especially if they're negotiating tactics, they'll be changing constantly. But what about manufacturing jobs? Are we going to see manufacturing jobs being created in the United States?
I think President Trump has a very specific goal of restoring manufacturing to the U.S., and you start to see that this is actually happening. The Japanese and Korean investments in plants in the South, I do see some aspect of insourcing by companies that want narrower and shorter supply chains. So manufacturing will come back. The question is it a 1 year or a 4 year proposition? Because it does take time to train, build, and get it going.
Well, in the meantime, we're seeing the consumer soften, but only slightly, right? And we're definitely seeing the consumer a little bit more worried about jobs in the future, a little bit more worried about inflation. Are CEOs concerned about U.S. consumer buying power in the next 6 months?
I think CEOs are nervous because they start to see trading down to private labels. They start to see longer buying spans, but for a tube of toothpaste or whatever. And these are just first signs, particularly in the bottom quartile of population, which I think is a sign of stress. And also credit card debt is increasing. Yeah. So, it's a K-shaped kind of economy.
Richard, you've been doing this for a long time. Are there parallels at all, historical parallels, or have we sort of reached this Rubicon where it's just uncharted territory? I'm talking about in terms of sentiment, whether it's at the executive level all the way down to the consumer level.
I think we're in a different place because fundamental economic propositions that have been accepted for the last 25 years are being overturned. I mean, you'll remember that this whole idea of the end of history was proposed really when the Berlin Wall fell, and it was the triumph of capitalism and all this, and it hasn't exactly played out that way. And a lot of manufacturing jobs have moved outside of the U.S., and so people have said, I'm unhappy. I want to see a future. When only 30% of Americans believe they'll be better off in the next generation, that's hopeless. And it's worse in Europe. It's worse in France and Germany. So we've got to restore hope by showing people that, in fact, they can have good jobs and that they can make their families better off.
Yeah, and particularly in a country that's always been a beacon for opportunity and advancement. Rich, I have to leave it there. Really great conversation. Richard Edelman is the Chief Executive Officer over at Edelman as we continue to count you down to those closing bells. Just about 20 minutes to go. A closer look at some of the big movers on the day and a huge drop today. And a lot of the vaccine companies, including Moderna, this after a top regular at the FDA resigned over the weekend. That conversation coming up in our Stock of the Hour. This is The Close on Bloomberg.
Shares of Moderna and other biotech stocks are sliding in the wake of Peter Marks, a top regulator at the U.S. Food and Drug Administration, stepping down. In his resignation letter, Marks alluded to friction with HHS Secretary RFK Jr., a longtime vaccine critic, over the safety and transparency of vaccines. Joining us now to discuss is Max Neeson of Bloomberg Intelligence. Max, have we heard anything from the CEOs of some of these tech companies like Moderna, BioNTech, and so on, those that manufacture vaccines?
Not much in the way of explicit statements from these companies, and I think that's been a fairly consistent thread, not necessarily surprising given, I guess we'll call it the administration's reaction to dissent, so to speak. But from various organizations affiliated with the industry, lobbying, generally disappointed with this. Another sign of moving the agency away from sort of bedrock scientific principles, which is, of course, of concern for these companies and for public health in general.
So just give us a sense here. I mean, who are the people coming in? Is there a replacement for him? Who's the head of FDA now? I know some of these roles are still unfilled, but is this the concern that the people coming in somehow don't, how should I put this delicately, maybe don't have the same scientific rigor as the people going out?
Yeah, I think that's exactly it. Yeah. So there is a new head of the FDA, reported today, actually, that he was signed in last week, which was not previously known, and was aware of and consented to this decision. So two-part, that the replacements won't be, don't have the institutional knowledge, the same sort of attachment to science or sort of common perception of how it should be conducted, losing, just a continuity, and then specifically Marks has been very well regarded by industry, emphasizing flexibility in regulatory frameworks. And then generally just losing people at the FDA means timelines slip, things are slower, there's less room to do sort of innovative work to bring new medicines to market. So a lot of tricky things.
So if you're a Stefan Bancel at Moderna or Albert Bourla at Pfizer or any of the other CEOs, do you start ramping down your vaccine production?
Yeah, it's a really tricky question because Mark's leaving, I think, is it's hard to ignore. Let's say, just for a company like Moderna, which both has novel vaccines, novel rare disease drugs, another focus of Marx's. So things that require sort of complex new endpoints. So how do you measure if this drug even works? That's a thing of real regulatory complexity. And if all of FDA staff are sort of occupied with just trying to get meet their timelines for drug approvals, there's less room to figure out how to bring those sort of new medicines to market. So we may see a point where people do start to speak out a little bit more.
Talk about disruption and difficulty with your strategic planning. Max, thank you so much. That's Max Neeson of Bloomberg Intelligence, and Moderna down about 7.5% right now. Well, coming up, we're going to take you to the closing bell with Kim Forrest, founder and chief investment officer at Bokeh Capital Partners. Do stay with us. This is The Close on Bloomberg.
10 minutes until we get to the closing bells. Romaine Bostick alongside Bonnie Quinn on a day that, well, looked like it was going to be a lot worse, Bonnie. The S&P opened lower by about 1% on the day. The NASDAQ was down 1.5%. Look at that. It's green on the screen. Yeah.
What is this end of quarter optimism, or is this April Fool's early, you think?
Yeah, it could be a little bit of a rebalancing as well. Remember, this was an awful month, and it's actually going to turn out to be an awful quarter despite the green on your screen. Remember, you had a NASDAQ down 8% on a month-to-date basis. The S&P down 5-6%. Even the Dow was down about 4% or so. So maybe you are seeing some of those losses turn into either maybe dip buying, or maybe it is some sort of rebalancing here on the final day of the month.
Yeah, and a little bit of window dressing as well, I'm sure, Romaine. But as you said, we are up 0.7% on the S&P 500. That doesn't really help the quarter. It's still down almost 5%. The NASDAQ 100 is up 0.1% as we head towards the close. We have the 10-year yield there at 421.86, so just a little bit further lower as we saw more buying today in treasuries. It was really a risk-averse day in spite of what you see on the screen. And then gold, constant records today, and we're basically at another record now, 122.81.
Yeah, the dollar relatively unchanged on the day, as is crypto. Bitcoin still camped out at that 83,000 level here, well below that all-time high that we hit just a few weeks ago. Kim Forrest joins us right now to help us count down to these closing bells. She's the founder and chief investment officer over at Bokeh Capital Partners. And Kim, this is one of those days where I think going to have a lot of people scratching their heads. We've seen this tug of war in the market, these huge sell-offs. The dip buyers come in. It's hard to understand what the psychology is, whether they're finding value or whether it's just kind of a repositioning of the ships. But a lot of people are still worried about what happens on April 2nd, and more importantly, what happens well after April 2nd when we start to see the actual ripple effects from any tariffs implemented. Are you worried?
No, not really. I'm never someone that gets upset about the short term. And these tariffs, I believe, are going to trouble markets for the short term, but markets adjust really quickly. The way I like to think about markets is people showing what their ideas are, but they do it with money by buying and selling things, right? And we have just come out of an election season where pretty much the polar opposite of candidate replaced the incumbent candidate. So the markets have been processing this for the last, 4.5 months. And here we are at another pivotal point with tariffs perhaps coming in. Mm-hmm. And we still don't have a good feel for what these are going to do in the very short run. But I'm always looking 3 to 5 years out, not for the next 15 days.
Yeah. I am curious as to what's even drove the sell-off, because even before we got the rebound on this day, there were a lot of names in the green and a lot of names that are very exposed to economic conditions like a Visa, like a Home Depot, like a Johnson & Johnson, Apple. But then what you saw down were a lot of those big tech names, the NVIDIAs, the Amazons, Microsofts, and Teslas. And it raises the question that some people have posited on this program that the sell-off that we've seen over the past few weeks was less about tariffs in the economy and more about just an overvaluation in that AI trade and the ancillary trade that went along with it.
I completely agree with that. Like 100%. If I could agree more, I would, but I can't. But, if we're looking last year at this time, even though NVIDIA had doubled or quadrupled or whatever kind of crazy multiple from the year before in 2023 to 2024, it still had a good ways to go. And people were just kind of waking up to the fact that AI was a real thing and maybe it could be productivity enhancing and all of that good stuff. Right? But NVIDIA pretty much ruled the roost until September when the Magnificent Six took over, and started, because the 7 is NVIDIA, right? Mm-hmm. So the rest of the Magnificent 7 kind of picked up the way forward. But here's the bad news. It was all kind of on, the investors had a short-term visibility, and when that didn't play out, and when it looked like it was going to be a much longer slog to make AI really meaningful, I think they've bailed. And I think that is what we're seeing over the last couple of months and why NASDAQ has continued to suffer in spite of, a lot of the other companies kind of rebounding and even being higher than they were last year at this time.
So, Kim, what do you do? I mean, if this is not the clearing event that perhaps markets were hoping for, do you take a step back and just wait for the clearing event, or just wait to see if this volatility continues?
I think we can assume that volatility will continue, but how much and when, we don't know, right? We never, ever know the future. And I know that everybody that comes on here, and including me, I will tell you what the future brings, but we know it with very little certainty, other than the sun's going to rise tomorrow. That's about it. So that being said, I really like to be fully invested, or as fully invested as I can be. And because good things happen to companies. Just because tariffs are going in doesn't mean that maybe a merger is announced or a discovery. You don't know. So you try to pick really good companies.
Take an example. I've been looking at NVIDIA all day and just curious about it. It's trading at 108 now. It was down to 105, a little below it actually earlier. Is that more fair of a valuation for a company like NVIDIA, or do you have to now take the wider stock market and economic backdrop into account when you're deciding what is fair value for a company like that?
Well, I think the whole AI thing is a special trade because the companies who are most invested in it, which are, part of the Magnificent Seven, they actually don't have to look at what's going to happen this year. They have enough money in the bank to fund this. Seriously, Microsoft, even Apple, Google, Meta, they don't need, an upswing in activity in their marketing or in their company to continue funding it. So I think it's a pretty good bet that that's going to play out. And I think investors have to look at each case and see, does this company's spending depend on the livelihood of its ongoing business? And in this case, the answer is no.
All right, Kim. I was hoping to leave things on a high note, but we have to leave it there. We're out of time here. Kim, always a great conversation. Kim Forrest.
Thank you.
She's the founder and chief investment officer over at Bokeh Capital Partners here on this March 31st, last day of the month, last day of the quarter, as we take stock here of a market still trying to suss out exactly what some of these policies out of Washington will mean. Policies, of course, Bonnie, that have kind of sucked the air out of the room on a lot of levels, but this is crunch time. April 2nd, Liberation Day, and then just a few days after that, the start of earnings season.
Exactly. We have to wait for responses from other countries and what they're going to say and what they're going to try and negotiate. But yeah, I mean, and the problem is, you want to pick the bottom, don't you? Most money managers would, or at least they would want to try. And when you see those days where we see 2% plus gains, it's heartbreaking if you're not in.
Yeah, hard to believe that anybody actually picked what would have happened over these last 3 months here. Maybe the next 3 months are different. As we continue to count you down to the close, our global simulcast starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Bonnie Quinn today as we take you through that closing bell with a global simulcast that starts right now. Carol Massar and Tim Stenovic join us from the radio booth. Scarlett Fu and Alex Seal are off today. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube on a really topsy-turvy day to end what has been a wild quarter. We look like, Carol, this was going to be an awful day here. Markets were down 1-2% here across the board. But as we get to the closing bells, almost all of the major indices in the green.
Yeah, I'm kind of shocked, right? What a different day from where we started at 9:30 this morning to where we are today to see all of these major averages in the green. And I'm looking at a VIX that's barely higher, just below 22, despite, I feel like, the swings we continue to see in the trade from day to day.
Yeah, unclear to me exactly what happened midday when you started seeing quite a bit of buying here. Was it the fact that investors were coming in and buying the dip? Does it have to do with the end of the quarter here? Unclear to me exactly what the prompt was for this. However, I will say the S&P 500 was down as much as 1.7% in today's trade. It's up about 0.6% now.
Yeah, I mean, quarter end, a little bit of window dressing perhaps, but don't forget we also have non-farm payrolls at the end of the week to get to, and there might be a lot more volatility to come. And Carol, to your point, that VIX at 22, it was much, much higher than that just after the opening bell this morning.
Yeah, absolutely. Here right now, we're looking at an S&P with the majority of the stocks in the green, about 380 stocks roughly moving higher on the day. And that includes some big names like an Apple, Visa, Walmart, Berkshire Hathaway, AbbVie, some of the other big cap tech names sitting this one out. But it doesn't matter. This is enough to pull the S&P 500 off of the abyss for the day, which was down more than 1.5%. It's going to end the day higher by about 0.5%. We should point out, despite that, here on a monthly basis, the S&P down 6% and down 5% for the quarter. The Dow Jones Industrial Average up more than 400 points here on the day, though, like the other indices, is going to finish the month and the quarter lower, down about 1% here over 3 months. The NASDAQ Composite down 24 points, or about 0.1% here on the day. The NASDAQ 100 unchanged, but both of those indices lower by more than 8 to 10%, depending on which one you pick. And let's take a look at the Russell. It's sitting this one out here on the day. It did claw itself off of the lows of the day, but still finishing down 0.6% on the day. And for the quarter, Carol Massar, it is down 10%.
Wow, that's a big move to the downside. S&P 500, if you looked at it earlier today, the split in terms of winners and losers, very different. So here we are at the close. And guys, we've got 390 names in the S&P 500 gaining ground today, 109 to the downside, and 94 unchanged.
Yeah, and if you look into the map, Carol, it's so fascinating. It's basically a green pie today, right? Most sectors, with the exception of consumer discretionary, higher, and that was down by just 0.2%. But if you look from the top, it is those defensive type of sectors that did best. So consumer staples, financials, energy, materials.
All right, let me get to some of the individual gainers. I probably could have changed my list, but this is what I came up with about midday today. All right, Newsmax, how to do it, an IPO. I mean, at its highs, this stock, up 735%. I don't even know how you explain this one. We had opening 40% above their IPO. $10 a piece was the IPO. Stock closing at just under 80.
What's the explanation for this? Because this actually isn't how you do an IPO, because technically that's 735%, or at least 734% of it should have actually gone to Newsmax and not to secondary investors.
Anything left on the table? Should we even ask? I mean, I
don't know. Who were their bankers? Because I would like to talk to them.
I don't know. We need to talk to him. I mean, Tim and I have been talking about this too. Like, how do you make sense? A lot of volatility in trading. We did see it halt at one point. I kind of can't wait until their first earnings so that we get a peek a little bit more into the business there. All right, moving along. AIG, guys. This was up about just shy of 4%. Held an investor day today. Shares rallying after the insurer authorized the repurchase of as much as $7.5 billion of its common stock. It also made some talk about planning to allocate more to private assets, looking to grow its net investment income. All of this coming in their investor day. But nonetheless, this was easily an outperformer today. Here's another one. Corcept Therapeutics up 109%. It's a $10.5 billion market cap pharma company. Shares surging as much as 114% at its high today. Heavy volume. Drug developer said a late-stage trial of its experimental combination therapy for ovarian cancer met its main goal. So investors investors moving big time into this one.
Can I just add an honorable mention, which was Warner, since we're talking about the media, Warner Brothers Discovery actually rallied about 3.5% on the day. There was an interesting report, Carol Masser, that a lot of cord cutters, those people have canceled their subscriptions, having second thoughts now because the price of streaming services have gone up.
Hallelujah.
Hallelujah. Absolutely. Well, for our benefit, thank God.
Something's got to give, right? Yeah.
Come back.
Thank you for that.
You're welcome.
I'll take it.
And on a high note, let's go to a down note with Tim Stenovec.
Yeah, let's talk about the Mag 7 Total Return Index. Initially, this entire index was down more than 3% on the day today, down 3.6%. It ended up, with the buying closing down only 0.4%. It does, of course, include the Mag 7 stocks. At 1.6 of the 7 were lower. 4 of the 7 fell today, still weighing on the indices: Tesla, Nvidia, Amazon, and Microsoft. Moving on to Moderna, shares falling by close to 9% today. We did see vaccine and biotech stocks fall after Peter Marks left the FDA. He's a top regulator, casting uncertainty about the future of vaccines and cutting-edge gene therapies. In his resignation letter, Marks said he'd been willing to work with Robert F. Kennedy Jr. to, quote, address the secretary's concerns regarding vaccine safety and transparency. But he continued saying it became clear that truth and transparency are not desired by the secretary, but rather he wishes subservient confirmation of his misinformation and lies. Interestingly enough, later in the session, we saw Cantor Fitzgerald analysts come out with a note on biotech analysts saying that the Trump administration should reevaluate HHS RFK Jr.'s role after this vaccine official stepped down.
And we just point out, I was looking at the decliners on the day, Tim. At least if you go into the small cap space, it's all biotechs. It's the top 20, 25 decliners were in the biotech space.
Yeah, no shortage of decliners to choose from today. Pretty remarkable moves when it comes to the biotech space. Finally, a little M&A news today. Rocket Companies down 7.37%. This after the company said it is acquiring Mr. Cooper Group in an all-stock deal valued at $9.4 billion. This will create a mortgage behemoth that handles 1 in every 6 mortgages in the U.S. Shares down by about 7.4% today.
Yeah, absolutely. Well, let's take a look at what yields did on the day, because that was just as wild of a ride as what we saw in the equities space here. You look at that 2-year yield, and I'm going to point that out. 2 basis points lower on the day. But here's the thing. At one point, it was down 8 basis points on the day. At one point, it was up a basis point on the day. And we saw similar moves on the 10-year, on the 30-year, on the 5-year as well. So a lot of volatility, even though the end result of it all was relatively unchanged across the board. But it just gets to that sense here that investors are really having a hard time figuring out what the direction is for this market, whether it's in the equity space or in fixed income.
Yeah, it's kind of like, where do I go? Where do I go? Hey, listen, I just want to get back to you because you asked, Romaine, and I like to answer your questions. Newsmax's offering led by Digital Offering LLC. I don't even know who that is.
Okay, well, we're going to find out who they are and why they left us 700 and something percent on the table.
Now the ball is in your court.
I just want to just point out real quick, too, because on Treasury, sorry to keep going back and forth here, because I was looking at you actually made money on a total return basis, not only on Treasuries, but even if you were invested in just total global fixed income. So, basically investment grade bonds as well as Treasury bonds. And this was like the widest outperformance we've seen in the fixed income space relative to the equity space since at least 2022. So significant to see that the relative safety of fixed income actually worked to the advantage of a lot of these investors this quarter.
Yeah, interesting. And to see how much then investors have really pulled back on equities and looking for something else, right?
Have you been invited to Jeff Bezos' wedding?
Maybe.
I was told the invitation is in the mail still. So maybe that's why.
Who told you that, Tim?
They're not doing an Evite this year.
They're doing it in Venice.
They're doing a real invitation.
I can't understand how they're going to only invite 200 people. Do you know how difficult it is to invite only 200 people to an event?
Well, if you have Jeff Bezos' security, I'm sure they can make sure to keep out the unwashed masses. But Venice was kind of upset about this. They were like, the Venetians, they were like, how are we going to handle this influx of all these, rich folks and their super yachts and super cars and taking over?
Did you say the Venetian in Las Vegas, Romaine? No?
No.
Can I just say
this is
it's actually the real. The real
I'm just checking.
Venetians.
Okay.
It sounds like Mr. and Mrs. or soon to be Mr. and Mrs. Bezos have screened out some guests.
Screened out.
Well, it's apparently.
Is he going to invite like the president? Because wasn't he at the inauguration?
I saw that.
That's
definitely Ivanka is on the list according to People magazine and the Kushners.
I did see in an earlier report that the president has been invited.
Yeah.
What do you get Jeff Bezos and his wife?
Anything they want, apparently.
Yeah.
I don't know.
Crystal?
Candle?
A pillow for, a space
Does he need like an ironing board? Or
down
does he have like a registry where there's just like pots and pans and,
I don't know, but they were definitely in the Dolce & Gabbana store on Sunday, which was not what I was doing. They were shopping for wedding dresses.
Are you spying on them?
No, I keep up with the old TMZs of the world.
You're stalking them?
Yeah.
No. All right, that's a wrap. Across platform on radio, TV, YouTube, Bloomberg Originals. Monday is almost over. All right, guys, we will see you again, same time, same place tomorrow.
Our coverage continues here on Bloomberg Television, a focus up ahead on Liberation Day and a focus deeper into the future on American exceptionalism. Is it behind us? That conversation coming up after the break. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Vonnie Quinn.
And I'm Romaine Bostic. Vonnie, the word of the day, at least early in this session, was really sell-off. By the end of the day, the word of the day was, volatility. A market that was down more than 1% on the day, for some of the indices more than 2%. But as we got closer to those bells, you did see the dip buyers come back in, bidding up the major indices, and most of them did finish in the green. An S&P 500 that was down about 1.7% on the day, finished higher by about 0.6%. Similar moves for the NASDAQ as well as the Dow. We should point out, though, for the month and for the quarter, this was bad. Going back to at least 2022 for some of the major indices, we haven't seen anything like this. We're talking about 5, 6, 7% drops on the major indices. For the consumer discretionary space on that level, we saw a 9% drop this month, 13% on the quarter, as a lot of people sold off those discretionary stocks in the face of concerns about tariffs and, of course, about consumer spending. Similar story for the automotive sector, which continues on the back foot. It's not just the automakers themselves people are concerned about, but the parts makers. That parts ecosystem very much intertwined with the global trade system, a global trade system that, at least for right now, appears to be upended. And then the flight to safety. We saw that in treasuries. We also saw it in gold, Vonnie, 31.24 and change. That's a record high for spot gold.
Well, and the last few minutes of trade, as you say, Romaine, we did see many investors gobble up some stocks, but throughout the day we saw this massive retail trade into Newsmax, newly IPO'd. So this is a tale of two IPOs, as you can see right here. Newsmax opening at 10, went straight to, it was IPO'd at 10, opened at 14, and then it just continued to go higher and higher, had a little pause in the day, and then finished off the day up about $10 from its previous price. Several volatility holds throughout the day, and buyer beware. This is very much a very precarious place to be right now, but if you're a retail trader and you did well today, I guess congratulations. CoreWeave IPO investors didn't have the best day either. Now, it might be a consolation that the whole market was down, but that stock, even though it finished at its IPO price on Friday, was down more than 10% at one point today, finished down 7.3%. And Tesla, just picked that as one of the examples of a Mag 7 stock that really didn't do well today either. Tesla, you might have thought, would be a little bit immune to auto tariffs, given that it's more made in the United States than some of the other automakers' vehicles. But no, Tesla also getting a bit of the brunt of the selling today, Romaine.
All right, and we talk about that volatility that we saw in the market, in equities as well as in the fixed income space ahead of Trump's so-called Liberation Day on April 2nd, Wednesday, which has spurred a bit of an exodus earlier in the session from risk assets in favor of safe havens. That was the story today. In fact, it was the story really for the last month or so. Treasuries outperforming U.S. equities this quarter for the first time in 5 years. Collin Martin joins us right now, fixed income strategist at the Schwab Center for Financial Research, to talk a little bit more about that trade. And I was going through the numbers here, Collin. I mean, whether it's treasuries, whether it's the broader fixed income space involving corporates here, we saw significant outperformance relative to equity, something we haven't seen in quite a long time. I'm wondering, is this kind of a one-off? People run to safety now, and if we get some clarity on some of these issues that rattle them, do they pile back into equities, or is this the start of a longer-term trend?
Well, I think you hit the nail on the head, Romaine, with the uncertain aspect there. And if something gets dialed back a little bit, what does that mean for the markets? And that's how we're approaching the bond market right now in terms of our guidance to our clients. And we're really refraining from taking a really targeted approach to duration in terms of being too long or too short, because there is so much uncertainty. And if we were to get some news from the administration that maybe the tariffs aren't as aggressive as we expect, or the longevity isn't as long as we expect, then we can see risk assets perform pretty well. We can see Treasury yields start to rise again, because even though we've seen some soft economic data lately, mainly due to the uncertainty around tariffs, the hard data is okay. We ended last year on a relatively strong note. We haven't seen the soft data work its way into the hard data yet. So yeah, if we see that roll back a little bit, we could see yields move a little bit higher from here, and maybe risk markets perform well again. But it's really too tough to tell right now, because we get these on again, off again policies from the administration. And with all that uncertainty, it's tough to make a really bold call in terms of one direction or the other.
Absolutely. And maybe that's why you're seeing people flock to some of these areas. What about tips? Because it seemed like for a while there was a lot of talk about the inflation trade, the idea that if tariffs do prove inflationary, do you sort of pile back into tips and other sort of instruments that would protect you from an uptick in inflation? Did you see a lot of activity there?
We have seen a lot more interested in tips, because a lot of investors are looking for that inflation protection. What we always like to highlight with tips is that they can serve as long-term inflation, but they aren't necessarily a hedge. Now, last quarter, they did pretty well, and last month specifically. So far in March, they've been one of the best performing fixed income asset classes. But their prices can still move in the secondary market. That caught a lot of investors off guard back in 2022 and 2023. So if we see inflation stay sticky and maybe those growth concerns subside and yields start to rise, we'd still likely see tips prices fall along with them. So that's something that investors need to consider. But we still think tips are really attractive right now. For one, their yields are real yields. They're already inflation adjusted. You can get yields around 1.5% or so, depending on the specific maturity. And that means you can lock in a positive rate of return above the inflation rate if you hold those tips to maturity. So we think that's really attractive. And they can also make a lot of sense if we are actually in this slow or low growth economic environment and high inflation. A lot of people are throwing out the stagflation term. I want to stop a little bit, because growth isn't that low yet and it's not declining. And when we look at the inflation numbers, we're still around 3%. So nothing like the 70s that a lot of people are worried about. But if we do get that slow growth, high inflation period, then I think tips can make a lot of sense, because they're relatively safe, backed by the full faith and credit of the U.S. government, and they have that inflation protection component. So they can make a lot of sense, but they can come with volatility, because, of course, they are bonds and their prices can move in the secondary market.
Well, Collin, if we do get some kind of reprieve on tariffs, if they're not quite as bad as the Armageddon scenario that's being painted by the administration right now, or if they're going to take months to get implemented, or if they're implemented slowly over time, do we see a massive repricing once again in treasuries?
I think we could, but I don't know about a massive repricing. If we look at the range of outcomes for the 10-year Treasury yield, if we do get some sort of reprieve, I think we could see the 10-year Treasury yield get back to the 4.5%, maybe 4.75% area that we saw earlier this year. I think the 10-year Treasury peaked around 4.8% or so. If we look at what the actual upside is, it's probably not much higher than 5%, based on everything we're looking at right now. Now, on the flip side, if we do get, tariffs implemented for multiple countries at higher rates than expected and for a long period of time, then I think those growth concerns could, allow the Fed to cut more than expected and pull the 10-year Treasury yield maybe down to that sub 4% or 3.75% area. So we have this wide range, probably 100 basis points or so. But if we do get that reprieve, we probably would see an increase from here, maybe to that 4.5% area or so. And that's why we're stopping short of suggesting investors really take a long duration approach right now, because of the potential downside.
Well, we may know soon enough, or we may not. Collin, thank you so much. That's Collin Martin, a fixed income strategist at the Schwab Center for Financial Research.
We are getting some earnings, Bonnie. This involving PVH, the company behind Calvin Klein, Tommy Hilfiger, as well as Izod and Aero, out with results. And, well, the forecast actually looks really good. The company actually providing a forecast for sales growth that it says will be flat to slightly positive, but analysts have come into this quarter actually expecting a drop in sales for the year. Now, for the recent quarter here, we did see those numbers miss a couple of estimates, but overall, the company providing guidance that is well above street estimates. Adjusted EPS for the first quarter, the quarter we're in right now, 210 to 225. That's right on the nose here of what the street was looking for. Similar story when it comes to their revenue guidance as well.
And you know, it's interesting, they plan an accelerated share repurchase program, $500 million worth of shares. And I wonder if we'll see more companies do that, Romain, with stocks, you know, maybe perhaps down, but companies perhaps still having confidence in their businesses. Well, coming up, is U.S. exceptionalism behind us? We'll discuss that next with Allison Schrager, Bloomberg Opinion columnist and senior fellow at the Manhattan Institute. This is The Close on Bloomberg. Well, many investors retreating from U.S. stocks as uncertainty around trade and the strength of the dollar lingers. Our next guest poses the question, is this how American exceptionalism ends? Writing, quote, the short-term boom may indeed be fading, but exceptionalism should endure over the longer term because it is more durable than whatever damage any one president can do in a few months. Joining us now is Allison Schrager, Bloomberg Opinion columnist and senior fellow at the Manhattan Institute. All right, prove that America can withstand all of this uncertainty, the potential for an awful lot more chaos, the idea that, you know, we're already not at the top rating when it comes to Fitch and S&P in terms of credit ratings, and there's a lot more that could still be done damage-wise.
She comes in hot with the first question, by the way.
Well, there's the things that make us exceptional in the short term and the long term. And I think definitely the uncertainty is posing a lot of risk to our short-term exceptionalism. Mainly the fact that our stock market just seems unbeatable compared to everyone else, and probably the fact that the dollar is just so valuable compared to every other currency. But I mean, really, if you look at American exceptionalism, it's something that's been true for much longer than Trump, or even much longer than our lifetimes, which is really about risk-taking, dynamism, entrepreneurship, and sort of an openness and to new things.
Sure, but it's to do with conditions too, right? If America was open to entrepreneurs, to immigrants, to all sorts of newness, then that's where people flock. But if America suddenly closes down to all of that and say an India or a China puts conditions in place, then you know what's to stop entrepreneurs moving?
Well, I mean, China still doesn't have a very good risk-taking culture. I mean, you still have a government that really tries to control the economy. So, I mean, that's one reason why they're sort of starting to fall into what economists call that middle income trap, where they grow very quickly as they adopt new technology, but haven't really been able to prove they can sustain it. And they have a lot more headwinds than we do right now. I mean, what's exceptional about America is it's always had relatively high growth for a mature economy. And that really comes from an openness to risk-taking that Europe hasn't had, which mature East Asian countries haven't had. Yeah. And so that's just a lot harder to kill, no matter how hard we try.
I think it's interesting, too, because, I mean, look, we could have been having this conversation a few decades ago about UK exceptionalism, and before that, I don't know, with the Ottoman Empire or somebody. I mean, we go through these cycles throughout human history. I am curious as to not so much what kills it, but what got us here in the first place. I mean, when we came out of the World War II era, there was a sense we kind of got lucky on a lot of things, whether it was the dollar effectively becoming the global reserve currency, which I'm not sure was by design, but that's kind of how it happened, as well as some other policies that worked to our advantage here in the United States. Is it possible that there is another country or another region or bloc where it may work to their advantage going forward?
Nothing lasts forever, including American exceptionalism or the greatness of the American empire. But right now, there really isn't another contender. I mean, I think Europe would like to be, and they thought forming together in the EU might do it. But so far, it doesn't look likely. I said China has a lot of headwinds, maybe India in the future. But right now as well, they have a lot of structural issues that are going to keep that from happening.
How do economies, though, transform? Because if you believe Trump and take him at face value, he's trying to transform the economy, at least in his vision, for what he thinks will put us on a longer sustainable path. And I'm sure we're seeing the same thing with the management of the economy in China, and maybe I don't know what Europe is managing, but I think they at least want to see that as well. What sort of gets that, becomes that catalyst for really transforming an economy?
Well, it's not management; it's the opposite. Because if you look at what made the UK a great economic powerhouse, it was the first to industrialize. It adopted and came up with new technology more than any other country, and it did it first. And that's what really, it wasn't really the mercantilism people always say it was. It was really the ability to innovate quickly and be the first country to industrialize. And then we took that mantle from them by sort of in the post-war era, sort of being the one to sort of adopt new technology and come up with it. And you can't plan that. Central planners always want to, but really you have to sort of spark the sort of fertile ground for innovation and risk-taking.
Exactly. You can't plan what's ahead. So, what if we have another scenario, like, say, Texas decides it wants to secede?
Well, that would be bad.
Wow.
Yeah.
No, but I mean, there's other ways that this can move, right? It doesn't have to be, America loses its exceptionalism. It can be a state or a couple of states getting together and deciding, well, the rest of America is crazy. We're going to just, do away with bureaucracy, have a great corporate environment, and everybody will come here. We see Texas doing it already.
I mean, so far federalism is held up and gives states enough autonomy that they haven't done that. But again, nothing lasts forever. I think what we have going for us, despite some sort of questionable decisions lately, is, as I said, we really are still the least dirty shirt on the floor. And there's really no other contender.
All right, Allison, I have to leave it there. Allison Schrager of Bloomberg Opinion coming up here, a continued focus here on some of the changes to our economy, a conversation about pharmaceuticals, autos, chips, all of the industries potentially being impacted by Trump's tariffs. Emily Field, Director and Head of European Pharmaceuticals over at Barclays, is going to be joining us. And we're going to hear from one of the bigger auto dealers in the country, Ricart Automotive. Stick with us. This is Bloomberg. Shares of biotech stocks plunged today after a top regulator here in the U.S. at the FDA stepped down, casting uncertainty within the industry as a direction of U.S. health policy. This as the pharmaceutical sector also braces for volatility as we inch closer to Trump's Liberation Day, a day where he promises to announce retaliatory tariffs on some of the U.S.'s main trading partners. Emily Field is Director of Head of European Pharmaceuticals Equity Research at Barclays. She joins us right now over there in London. And Emily, I want to start off first with the news that actually broke late Friday with the head of basically the main biologics agency underneath the health department leaving and publicly making it clear that he left because of disagreements about the direction of policy on vaccine and vaccine development under RFK Jr. Is this something that's resolvable?
I think it just raises a lot of questions about the direction that this administration is going to take as it relates to drug and healthcare policy. Peter Marks is someone that the investment community knew well. He spoke at investor conferences. He was accessible. So his departure, and obviously he released a very strongly worded public letter, I think just raises more and more questions about what direction vaccines, for example. We've seen some advisory committees postponed, rescheduled, FDA, can we rely on them as we have been able to in the past?
Yeah.
That's not so sure anymore.
And just for our viewers, I mean, when we talk about this process of getting drugs approved, I mean, basically, obviously, these companies do a lot of research and stuff on their own. But at some point, they have to present their findings to these FDA panels, basically argue their case. It's almost like, defending a PhD thesis or something. You get peppered with questions about the efficacy and safety of these things. Those panels, though, are usually made up of independent advisors. Are those folks not going to be as scientifically rigorous as they were in the past? What's the fear?
Yeah, that's also a great question. And I think, it's an unknown at this point. Theoretically, FDA should be very, very much data driven. I know that RFK Jr., one of the things that he said is that he's wanted to eliminate conflicts of interest within these agencies. However, a lot of the drug approval process at FDA is funded by industry. I think as we're in the early days of this administration, we just don't know how this is going to impact the drug approval process in the coming years. And uncertainty is not something that pharma and biotech investors like.
Emily, can we at least say that the next person to take over the slot is going to be more ideologically aligned with RFK Jr.? Is that even a certainty? And if it is, I guess you can then plan for at least maybe a slower research environment at least.
Yeah, I mean, clearly RFK Jr. has made his views on vaccines very well known. We also know that he is going to be sponsoring, an investigation into vaccines and autism, which has been widely debunked. However, I think, will this impact the broader drug approval process? It's far too early to say. When we are asking our companies, we just had our global healthcare conference a couple of weeks ago. They said that they're not noticing any changes as of yet. However, these are very, very high profile departures, and it just raises this specter of uncertainty.
Emily, how are you gaming out tariffs and how they're going to impact European drug companies? And then on the other side of things, many U.S. drug companies have headquarters in countries in Europe too.
Exactly. And so when we take a step back, none of our companies have necessarily quantified the impact of tariffs because there still are so many unknown questions. And these are companies with very, very global supply chains. However, I think that, pharma having been excluded from tariffs historically across the board, the fact that they're included now, I think just sort of means that perhaps pharma in these times of growing economic uncertainty isn't the defensive sector that we thought it would be. And also, I think investors are getting increasingly concerned that is something regarding drug pricing in the U.S. back on the table, whereas we thought that was kind of a moot point following the passage of the Inflation Reduction Act.
Yeah, it's going to be a busy time for every industry, it seems like. Emily, thank you so much for your time today. Emily Field is Director and Head of European Pharmaceuticals Equity Research at Barclays.
Yeah, and with that downdraft that we saw today in those biotech stocks, at least as measured by the NASDAQ Biotech Index, certainly concerning, down 2%, but on a monthly basis, it's ending the quarter, down a couple percentage points as well. And on the month, down about 6 percentage points here on the day. On the quarter, I got to get this all straight here. The S&P 500 Consumer Discretionary Index, while it doesn't look like much, again, these are daily prices that you're looking at, price changes here. But on the quarter, Bonnie, it just got decimated, down 13-14%. If there's any industry that's going to be affected potentially by increased tariffs, there's going to be a lot of the retail companies, apparel makers that really do depend on overseas factories and warehouses for their goods.
Market's certainly speaking, Romain, but is the administration listening to the market? We ask the question about the Fed all the time. Does the Fed listen to the market? Does the market lead the Fed? Is this market ever going to lead the administration? Because for right now, at least the president says he doesn't care where stock prices go because it'll be okay in the future. Sounds a little bit like those effective altruism arguments.
It'll be interesting to see whether we get a further downdraft in the market and whether that does rattle cages. Remember, we did sort of dip into correction territory a few days ago. We're out of that, but still down 9% on the S&P, 7% or so on some of the other indices here. But when you look at the sector indices, that's where a lot of the pain is. I mean, keep in mind, you have 5 of the 11 S&P sectors that are either in correction or bear market territory. And you have certain sectors like the automotive sector, at least if you take the S&P 1500 automotive sector, that's down 30% this quarter alone.
Well, we're going to talk to somebody up next just on that itself, right, Romain?
Yeah, absolutely. When we come back, closer dive into that automotive sector. Stick with us. This is Bloomberg. All right, it's not just anecdotal. We've seen evidence here that a race is on to buy new cars ahead of a potential increase in tariffs on autos imported into the U.S. President Trump promising 25% tariffs on finished vehicles coming into the U.S., as well as tariffs on some of the parts coming into the U.S. a little bit later on May 3rd. And that has set off buyers and sellers across the U.S. to try to lock down deals, fill their lots before they take effect. Let's get some perspective of a major auto dealer. Rhett Ricart joins us right now. He's the CEO and dealer principal at Ricart Automotive, which has car dealerships selling several brands in the Columbus, Ohio area. That includes Fords, Nissans, as well as Chevrolets. He's also the Ohio director for the National Automobile Dealers Association. And Rhett, I have to ask you the question I ask every CEO that comes on this program. How difficult is it right now to sort of plan out for the next 6 months to a year, knowing that tariffs could be in place? Maybe there's a negotiation that rolls them back just as quickly as they came. What does that planning process look like right now?
Well, thanks. Gives me a chance to shed some light on this situation because I'm sure everyone's kind of guessing out there with it. I mentioned in your earlier article in Bloomberg, it's like a Ouija board. No one has the answer. I'd be Nostradamus, but I do know this from all the manufacturers as well as the other dealer bodies I've talked to in the country. I just got back from a meeting. The fact is that this has put tremendous pressure on the manufacturers to be able to know what model to build under what combination and under what customer incentives they can put behind it to be able to get it to the public at an affordable price. This is all about affordability for the customers. Just recently, we just saw in the last week a huge spike in used car prices at all the major auctions throughout the United States for dealers that are trying to hold on to their inventory as well as holding on to their inventory because they really don't know what the pricing is going to be on some of these vehicles in the future. The customer, yeah.
What are their lots going to look like? Because, I think back a couple of years ago because of the pandemic and supply chain disruptions, I was in the market for a new car then, and you would go to dealer lots, and they didn't even have anything for you to test drive. You basically just had to pre-order and wait for it to show up on a boat. Are we headed back towards that type of situation, or will it be a little bit better?
Well, fortunately and unfortunately, I was the chairman of the National Auto Dealers in 2020, so I got a real good feel for that one. I don't think you'll see anything of that type of a manner. That was a complete shutdown of a lot of the manufacturers. That was the ability of customers to be able to find vehicles of their want and need. The logistics grid was all messed up. In this case here, the manufacturers are building cars. They're building cars right now, and they know that. They got to build cars to make money. They got to build cars to be able to keep their plants open. Many of them are under union contracts. So I think what you're going to see is a lot of vehicles being made, but the manufacturer is going to try to have to make up some of this price difference in either customer incentives, which is rebates, dollars on the hood, et cetera, and or different bundling combinations they can come up with to be able to get customers a car that they need that's affordable, even financing alternatives.
Well, exactly, Rhett. So what is the stance, if there is just one stance now, of dealers on their margins and how much they're willing to accept perhaps a cut in margin? Are they hoping that the manufacturer will take all of the pain?
Well, I don't think we'll ever see that. I've been around for 48 years. You'll never see one party there that take the pain. We are partners. We are franchisees of the American industry. The manufacturers supply vehicles for us. And we are the shock absorber, as I like to call it, with the consumer. We like to be able to absorb a lot of these costs, a lot of these fluctuations in demand, a lot of these fluctuations in model preferences, et cetera, et cetera. So I don't think you're going to see the dealers are going to probably get hit a little bit on this, and you're going to see the manufacturers. But, man, whoever's running these manufacturers right now, they have to be, this is going to be a tough time for them because they're trying to figure out a formula that they've never had to figure out before. This is new territory for them. It's just not getting a plan up and running. It's getting a plan up and running with the components that they can cost value put into these vehicles to keep them affordable for the customers or our consumers to be able to buy. So it's going to be very difficult for them to do. A lot of smart people I know, both domestic and import, it makes no difference. It's going to be a lesson for them.
Well, and Rhett, you also talked about creative ways of financing. Is there any thinking that there might be a change in Fed policy and that might impact things if indeed these tariffs go into effect and they're inflationary?
Well, the one advantage you could possibly have is in leasing. If you know that you're leasing a vehicle today with an ALG of 3 years from now, which is an estimated value, if there's 25% tariffs on that particular vehicle you're leasing, it's going to make that vehicle more valuable 3 years from now than it is now because the price of a new one's going to even be that much higher. So pre the institution of this, which is tomorrow, or I think it's the 4th of the month, you're going to see a lot of manufacturers push a lot of inventory. I had a call from one dealer this morning that he's receiving boatloads of vehicles from the manufacturer, trying to get them to the dealers ahead of this deadline.
Wow, a traffic jam, but not for normal reasons. Rhett, thank you so much for joining us today. That's Rhett Ricart. He is CEO and dealer principal at Ricart Automotive.
And as consumers, of course, try to get their heads around what used car prices may look like, new cars for that matter, there's a broader question here about whether they continue spending on other things. We've talked a lot about how tariffs will impact shopping habits. We had a chance to catch up with the head of a major media and cosmetics company here about where consumers aren't scaling back. That includes skincare and beauty products. Richelieu Dennis is the founder and chair of the Sundial Group of companies, known for its skin and hair care products like Shea Moisture. And I asked him if the sector was recession-proof. Here's what he said.
I think people scale back, right? But people are always going to take a shower. They're always going to wash their hair. They're always going to brush their teeth. They're always going to wear deodorant, right? Those basic things are always going to be there. And as people start to think about where they scale back, they're also looking for inexpensive indulgence, right? So, hey, let me take a bath instead of a shower. So I think, when people say that it's recession-proof, I think that it is, right? I agree with that. We've been through quite a few over our journey, but I think what's happening now is different from recession, right? I think what's happening now is that the consumer is going through an evolution themselves, right? We're in the middle. We're right in the middle of a generational shift, right? So you had millennials are now sort of the ones that are aging. You've got the Gen Zers that are coming in. You've got the Gen Alphas that are coming in behind them. Their mindsets are different. Their need states are different, and we're servicing them across different life stages now, right? Yeah. So multi-generational thinking in how we formulate products, in how we set up experiences, and how we drive outcomes is now that. So that's a really exciting place to be, because now we get to think about the next 2 or 3 generations and what it is that they're going to be interested in, how they're going to be living, and the things that are going to be valuable to them. And so that's where we're. And when you think about that, that's extremely exciting, because you get to redo things, you get to rethink things, you get to bring things to market in a different way.
There's a connection there too, and this even gets back to the experiences you're talking about with the media side. And I am curious how important that is. I mean, the brands that you shepherded to market, largely targeted at the African-American community. We're at a time where the political climate has shifted a lot. There are a lot of people that are making decisions, purchasing decisions, not just based on the economics, but on, to a certain extent, political and social beliefs. Is that something that you lean into, or do you kind of maybe try to stay a little bit further back?
Look, I think, as I said earlier, we focus on 3 things, right? We want to build for need states, right? We want to build for those need states across life stages, right? And then we want to take the mindset and apply that mindset. So need states, life stages, and mindsets, right? We're in an environment right now where that becomes the most valuable thing that you have, right? We're in an environment right now that's providing a lot of opportunities, right? A lot of new opportunities to black manufacturers, right? To black businesses. It's also taking away opportunities. We can't look at it as, hey, this opportunity is gone, so we're going to sit back, right? We have to look at it like, okay, what do our consumers need in these times? How do we provide for them in these times? And that's how we think about it. And so I think companies that are thinking about the long term, that are thinking broadly about how they serve their consumers, and how they're actually branching out and serving consumers that have similar need states, right, across different life stages, is where you're going to see growth.
You've taken a lot of your money and tried to sort of put that back into the next generation of entrepreneurs and founders. You have a fund called New Voices, which has invested a few $100 million. Dave's Cheesesteak, Lip Bar, Mael, I'm sure I'm forgetting a few others as well. Where is that next crop of entrepreneurs coming from?
So I think that next crop of entrepreneurs, interestingly enough, is going to be some of that same crop over the past 3, 4, 5 years, right? Because they're now mature entrepreneurs. Some of them have exited. They're moving into the next stage. They're moving on to new projects. So that's sort of one crop. The second crop, and quite excitingly, are those that are building businesses now around AI and new technologies and new new solutions to lifelong problems. So that's where we're looking. We're looking for who's now taking technology to solve problems, right? Whether it's in a functional personal care product or whether it's in a digital app that is going to solve for high blood pressure or for any of these other conditions. That's how we're looking at it.
Rich Dennis there. He's the founder and chair of a company called the Sundial Group of companies, which are a broad umbrella consumer products companies focused on skincare, beauty care, as well as media. A closer look at consumer spending as we do sort of march forward to that April 2nd Liberation Day, where we're supposed to hear from the president and exactly what type of tariffs, retaliatory tariffs, if you will, that he plans to place on our major trading partners. That includes a lot of folks in the semiconductor space. Stacy Rasgon going to be joining us after the break to discuss that aspect of it. This is The Close on Bloomberg.
We've been counting you down to President Donald Trump's so-called Liberation Day, hitting on the potential impact to key sectors like pharmaceuticals and autos. Well, now let's round things out with a look at the chip sector with Stacy Rasgon. He is Senior Analyst of U.S. Semiconductors and Semiconductor Capital Equipment at Bernstein Research. Stacy, who's most exposed, given what we know now about the tariffs and how much uncertainty there is?
In semiconductors, it's actually very interesting. We don't import tons of raw semiconductor. I mean, I think in 2024, it was like $82 billion, which seems like a lot, but in the context of a $600 billion industry, it's a minority. And we don't import a lot from any single country. I think Malaysia was the biggest source of raw semiconductors in 2024, about $16 billion. Taiwan was also only about $16 billion. Most semiconductors actually enter the country inside other things, inside PCs or inside smartphones, inside cars. So I actually think that the biggest potential impact is not direct, it's more the indirect stuff, demand destruction. If end products that they go into get more expensive and demand gets hit, and then you need less semiconductors. So it's actually very difficult to tell. Yeah. Even the companies that do manufacturing of semis here in the US, say like Intel or Texas Instruments, in many cases, those semiconductors that they make actually get shipped out of the country to get packaged and ready to put into products, right? They don't necessarily get consumed here. Semis is a very global industry. I forget how many different borders the average part crosses. It's tens of borders typically. So long story short, it's hard to know exactly like what the direct impact is going to be on anybody.
Well, but isn't that part of the fear, though, too? I mean, you mentioned everything going cross-border. I mean, same thing. I was having this conversation earlier with someone about cars, and cars, it's not really just assembled here and just assembled there. It's kind of assembled everywhere, and then somehow, the finished product shows up on a U.S. lot. When do you feel like you'll have clarity, Stacy, where you can actually start modeling in whatever impact?
I mean, who knows, right? I'm not even convinced we're going to have clarity on Wednesday, right? Because I'm not even sure Trump exactly knows what it is that he's going to say. And whatever he says, how do you know that it sticks? Like, this is actually a bigger problem. If we knew what he was going to do, out of 20% tariffs and everything, just boom, done. And we knew that was going to stick, then companies could plan around it. The problem is number one, you don't know what he's going to do next week, versus this week. And even if these things stick, these supply chains take a long time to move. To actually build capacity here for semis or frankly for any of the end products that they're going into takes years. You're probably stretching, beyond the scope of this administration. And so nobody knows what happens in 4 years. Do these tariffs or anything else, do they remain in place? And it just makes it very difficult for anybody to make large-scale capital decisions, just given the tremendous amount of uncertainty. So I don't know when we're going to have any clarity.
Yeah. Well, I think your last point about large-scale capital decisions, that seems to be the bugaboo right now. Stacy, we have to leave it there. Always appreciates the insight. Stacy Rasgon, Senior Analyst over at Bernstein Research, on a day where we are sort of looking ahead to 2 days from now, really, that Wednesday Rose Garden event that President Trump has announced to announce these tariffs on U.S. trading partners.
Exactly, and what the responses will be from those trading partners.
For more political coverage, stick around. The Balance of Power team is on deck at the top of the hour, right here on Bloomberg.